All right. All right, everybody. We got some people still coming in. Welcome. This has been a little bit of a ways in coming. I'm David Kinder, and I have with us today Michael Malloy. And I met Michael through a mutual friend and mentor. So I want to give a quick shout out to Professor Craig Hampton for introducing us. We met a couple of months ago in a private study group session, got a chance to meet and talk, and it was actually Professor's idea that we hold this session so that we can actually have a session about offshore private placement life insurance. And I have Michael Malloy's books, and again, as I've told him, I haven't had a chance to read them, but I have flipped through them. So they're well illustrated. But let me give a formal introduction here. Michael Malloy is the founding partner of EWP Financial, that's Extended Worldwide Planning Financial. Began his career over 40 years ago as a risk management consultant. He has published in the Life Insurance Law newsletter, has written 2 books on private placement life insurance, which is PPLI, the PPLI Papers, and The Wit and Wisdom of Professor PPLI. No relation to Professor Hampton. We did discuss that a couple months ago. Although the image was somewhat familiar that you mentioned on the book, on the the illustration of the bird that's right here. Malloy Insurance Services. Michael has managed several companies: Malloy Insurance Services, Advanced Financial Solutions, and presently EWP Financial. I have not yet allowed to share my screen yet, so that Michael can now share his presentation. He has a wonderfully simple presentation, yet it's a rather complex topic, and so I've got a few questions that we'll answer throughout. I think the only main thing is, and I want to touch on this real briefly, is that we're not going to talk about any company or carrier names, and there's a very specific reason for that. And if anybody here is a CLU, you'll know that if you have a not admitted carrier in the United States, anytime you mention that carrier name, it could be considered a solicitation, and so we're not going to be talking on any company name specifically. This is all a high-level overview, but we look forward to answering every other question, and I'm looking forward to seeing this again. So, Michael, thank you for being here with us today.
Well, thank you for having me, and hopefully we'll have a lively discussion about offshore PPLI. So, should I put up my slides here?
Yeah, go ahead. You should be able to.
Let's see. So what do you see?
I see nothing.
So I'm on PowerPoint. So I went into PowerPoint. Do I have to do something like share my screen or?
Yeah, so there's a share button. It's a green button there at the bottom. And then in sharing, if you can't find it, I've got it because I had you share your presentation with me.
Okay, let me go back to the meeting here. Share screen. Okay. So,
there we go.
Okay, so let me set up the slideshow. So,
perfect.
Are we there?
That's it. Oh, ready to go.
All right. So this is an introductory presentation on offshore PPLI. So if in the first quarter of it you don't hear the word PPLI, don't tune away. You're still on the same on channel here, but I want to put it in the proper context. So that's the reason for a little bit of a slow start, so to speak. So here we are at the, is the top cut off on yours, or what? Do you see the whole thing?
I see the whole thing. Yeah, we're
Okay.
good.
Okay, mine's a little cut off, but I'm familiar with them. So we begin here at the meeting of the Indian and Atlantic Oceans. and we see this mysterious white line. So that's what interests us here at Cape Point, South Africa. And for us, it's symbolic of all of the financial disciplines that come together to create an EWP asset structure. So we're going to call it the unifying force. So if it's a unifying force, what does it unify? It unifies these disciplines, which are usually taken separately. Financial planning, entity structuring, asset management, estate planning, asset protection, and last but not least, life insurance. So 2 questions we can ask each other on our journey is how can we benefit each other, and how do we materialize this benefit? So if we're going to bother to journey together, why not make it a happy journey? We could be strolling underneath these magnificent magenta leaves, or how about a trip to this fairy tale-like castle in Bavaria, Germany? Whoop, this is not a good start. Let's begin again. So at the end of our journey, we're going to have some case studies, which we call simple solutions for complex issues. So we saw what a happy journey might be like, but what about an unhappy journey? This guy looks like he's going nowhere, a stairway to nowhere. And this stairway doubles back upon itself. So again, you're going nowhere. How about falling endlessly into the murky ocean? Or would you want to be perched upon this precarious rock? So what do these images signify? Well, confusion, overcomplication, and uncertainty. It's a bit like the eerie feeling you get when you see this spider in its web. But for the moment, let's concentrate not on the spider, but on the web. Well, I first gave this presentation in Shanghai, China. And while I was there, I called on some advisors, and they showed me this diagram, which purported to be a way for non-US persons to invest in US real estate. And I found that it evoked the same feeling as the spider web. Confusion, overcomplication, and uncertainty. And we call this a spider web structure. And in our talk, we're going to learn to say no to spider web structures. Well, if our clients don't want spider web structures, what do they want? Here are a few things: privacy, a tax shield, asset protection, succession planning, compliance simplifier, and a trust substitute. Well, these are the very things that are mentioned under expanded worldwide planning on Wikipedia's page on international tax planning. And by the end of our journey, we're going to learn to say yes to an EWP asset structure. So what's the vehicle that allows us to achieve a successful EWP asset structure? Well, I'm going to give you a few hints. What do you think this museum needs in this moment? And what might this kind of insurance might this photographer wish he had? Well, I think you all guessed it. Life insurance. But not just any kind of life insurance. Private placement life insurance. So we've arrived at our topic. So interestingly enough, PPLI provides the same tax advantages as commercial or retail life insurance. So what are these? here everybody knows this, but it's worth going over. Tax-free or tax-deferred growth on the internal cash value, no capital gains taxes, no income taxes, tax-free death benefit in most jurisdictions, and the ability to pull out the cash value through tax-free loans. So what's different about PPLI? Well, it's most useful for high net worth clients with diverse investment strategies. So in a properly constructed PPLI asset structure, you can invest in real estate, physical assets, hedge funds, and other alternative assets, private equity, intellectual property, art, even yachts and private jets. And how is this so? Because PPLI focuses not on the death benefit, but on the investment component. It provides a flexible solution that, if done correctly, is totally compliant with tax authorities worldwide. So here we have a basic structure, not unlike an ordinary life insurance policy. You have a policy holder, the owner, an insured life or lives, a beneficiary or beneficiaries. What's different are the assets, which are usually held by a custodian, which is most often a bank. So what's the origins of PPLI? Well, it began in the 70s earlier in the US. It was first started by executives at Fortune 500 companies who wanted a different kind of pension plan than what was offered to the general populace of the company. In the early 90s, it was adopted by wealthy individuals, and by the mid-90s, major insurance companies came into the marketplace. So here we have Wikipedia's page on private placement life insurance, and in the section on expanded worldwide planning, we're proud to be mentioned as a proponent of EWP. So let's go over a few of the benefits. Tax deferral. We're going to look at a chart in the next slide. The assumptions on the chart are a growth rate of 6.5% annually and a combined tax rate of 49%. So we're talking about clients generally in places like California and New York. So here we have the PPLI structure in brown, the taxable investment in blue. So even after 10 years, you have 3.4 million more in the PPLI structure, 8.7 in year 20, and almost 50 million more in year 40. Asset protection. PPLI provides another layer of asset protection that's not available with a trust alone. How is this so? Well, in a PPLI policy, the insurance company becomes the beneficial owner of the assets in the policy. The insurance company is also listed as the beneficial owner on the bank account associated with the policy, and all transactions are done in the name of the insurance company. In the unlikely event of the bankruptcy of an insurance company, a client's protected because the policy assets are separate from the general account of the insurance company, so they're no longer subject to the creditors of the insurance company. Reporting. This is more for international clients. but we'll go over it briefly. Reporting is becoming more complex globally, but life insurance reporting is much less onerous than trust and other investment type of reporting internationally. These kind of structures can help with pre-immigration planning, what are called CFCs, controlled foreign corporations, if they are some of the assets inside the policy, and with FATCA CRS, the Foreign Account Tax Compliance Act, and the Common Reporting Standard. What's reported in terms of reporting is one number, the total cash value that's held by the policy, not any of the assets held or the underlying investments. Trust planning. Trusts are good. You get estate tax exclusion. It helps with generational planning, asset preservation, but does nothing to solve income tax and capital gains tax problem. Let's do a little comparison. On the insurance side, it's contractually based and used by millions. You get tax deferral. Insurance company becomes the beneficial owner. Simplified or limited reporting. You receive a tax-free asset transfer of investments inside the policy, and no capital gains taxes. On the trust side, it provides some asset protection, but it's sometimes seen as a tool for the rich. You have more stringent reporting requirements, and there's tax filings for the trust, and in some jurisdictions for the beneficiaries. And in and of itself, no tax deferral. So all that being said, most of our policies are owned by trust. So you get the best of two worlds when you combine these benefits. Well, how are you feeling up to this point? Hopefully not like this guy. Well, maybe a little like this guy. So now we're going to go briefly over our case studies. So hopefully you won't be scratching your head at the end. So we're going to call our case studies one simple solution. We begin with a New Zealand parent. She had 3 operating businesses based in the Caymans, 19 million in cash. We formed a holding company to operate the businesses. She had a son living in Florida that she wanted to pass things on to when she passed away. And the son wanted to invest in real estate with the profits from the operating businesses. And the real estate investments were going to be funded by loans from the holding company. So we go back to our basic structure. We have the New Zealand parent as the policy holder, with her as the insured life, the beneficiary being the son in Florida, and the life insurance policy at the center, and the assets, which I just mentioned. We move to the Wu family. They reside in New Jersey, husband and wife with 3 children. Mr. Wu is a citizen of the PRC, and Mrs. Wu has a green card. They had multiple real estate holdings throughout the US. They had portfolio investments, stocks, bonds, both here and in China. Total net worth, 75 million. They came to us to simplify a proposed structure, which looked a bit like the spiderweb structure we saw earlier. So again, same basic design. different assets. Now we have something slightly more complex, a global ultra high net worth entrepreneur. He had companies in the UK, Europe, US, and Africa. He had holdings in natural resources, sports franchises, media management, residencies throughout the world, UK, US, and Mauritius. Again, he wanted to simplify his existing structures and reporting obligations and pass things down to his wife and family through his Delaware trust, which was the owner of the policy. Again, same basic design, different assets. Now we move closer to home, San Jose family, third generation California residents. They owned and managed apartment houses valued at over $100 million. Again, they want to simplify their present structure and to pass things down to the next generation without estate tax. Again, same story, same basic structure, different assets. And we conclude with some real estate developers. They invested in US real estate, about $4 billion currently invested in US real estate projects. Their goal was to optimize privacy, tax efficiency, and asset protection for their US and worldwide clients. Again, a little more complex, but same structure. So I think at this point, you've all learned to say no to spiderweb structures and yes to EWP asset structures. We conclude with this slide to show our diverse client base. The man is purported to be the tallest man in the world, standing next to the Great Pyramid in Giza, Egypt, and the woman reported to be the smallest woman in the world. So this ends our journey, and thank you. So I welcome
Perfect.
your questions.
All right. So we got one question here in the chat. Jimmy Ray asked this. He says, so is the life insurance company, he left that word out, is the life insurance company buying the assets? Not sure I understand with the structure illustration.
No, they become the beneficial owner. There's not a sale per se.
Okay, excellent. Now, let's talk, because I got a few questions I prepared in advance that I'm thinking of, because most of this is going to be brand new to everybody coming on board. So if anybody's ever heard of domestic private placement life insurance and comparing that to offshore private placement, what would you say are the differences? I've got an idea based on one PowerPoint I downloaded from, and I can mention this company because they're here in the United States. It's from Prudential. They have a private placement life insurance policy. It's nothing like what you talked about. So if you share, what's the difference between domestic and offshore?
Well, the main difference is the offshore companies will accept in-kind premiums. And in the US, I think maybe in South Dakota, they've recently changed their legislation such that you can do a limited amount of in-kind premium transfers. But for the most part, the policies that are issued domestically in the US are not too different from a retail VUL. And in a retail VUL, you get menus of mutual funds, mostly, different categories. So there, you get a slightly broader menu, but for the most part, it's not too different than a kind of a off-the-shelf retail VUL.
Right. That was what I noticed. It's more of an institutionally priced uh, chassis, but it's not that much different. That's what I noticed as well. Um, the licensing requirements and E&O requirements for working with offshore is very different from working with domestic. Talk a little bit about that.
Well, for the offshore, each company has their individual requirements. Some uh, require others don't. Some have different licensing requirements, but you the main difference is you don't have to have a Series 6 65 registration like you do in the US, because
Perfect.
I mean, for the most part, these companies are based in Barbados and Bermuda, the most active companies now. So they've, in the early 90s, when kind of PPLI was just getting started, they've structured their laws to be, well, let's say PPLI friendly, and there's no securities requirements. I mean, they don't deal with them like securities like the US regulators do.
Right, exactly. So Robert Dillard asks, do all PPLI use VUL or whole life IUL? I know the answer, but please go ahead.
Uh, it's basically a variable universal life policy, and that's when you read the variable contract sections of the kind of Barbados and Bermuda legislation, that's how they refer to these policies, as variable universal life policies.
Right. And if we think about it, if we're putting in businesses into the policy, we're putting in collectibles, we're putting in other things that may otherwise be a security into the policy, by definition, they're automatically a variable policy. But that doesn't mean that they're the same as what's available on the retail side. These are very different in terms of, for example, the net amount at risk and the cost of insurance in the policy. Because one of the things that is on the retail side is that we're very concerned about that increasing cost of insurance on universal life policies. Yet this is structured so differently that that's really not the concern here with the policy.
Yeah, for the most part, no. I mean, uh, usually unless somebody had a particular need, you're structuring the policy so it has the lowest death benefit possible.
Exactly. Let's see. Rich Coffin asks, is there a minimum net worth of a client?
Well, in general, it's usually clients who are at the minimum 10 to 20 million range. And the company's minimums are usually around 5 million. But usually my advice to clients is, I mean, just basically financial planning advice. Don't put all your eggs in one basket. So you wouldn't want to put all your net worth into a structure. Or, I mean, I wouldn't recommend that.
Okay.
Just for general risk management reasons.
Sure. Richard Jimenez asks, is there a minimum annual premium? And of course, we're thinking about a traditional policy that normally has structured payments for 7 to 10 years plus. This isn't necessarily a minimum annual premium. How would you answer that one for us?
Well, in a general sense, there's two basic structures. There's a structure for someone who the main goal is estate planning. So this is somebody in their 60s, 70s, and beyond. And that's one structure. And then another is more for retirement planning. So building up, just like you would do in a retail VUL, but the numbers are bigger. So in the latter design, you have to have in the estate planning design, usually it's a very low death benefit. But in the retirement planning design, you have to have enough death benefit to accommodate the corridor rules. You have to have enough. So sometimes you run into, if a client wants to put in those situations a significant amount in, you have to put it in over time. So that's
Okay.
and that kind of softens the amount of death benefit that you need to accommodate the larger cash value.
Okay. I wasn't familiar with that one, so good. Glad we asked that one. I want to talk a little bit real quick. Are there age limits, and what is the underwriting like?
Uh, I would say in general, the underwriting's not too different. And usually it's somewhere around 85 for the age limit. But there's more flexibility in terms of uh, the insured life or lives. There's still insurable interest rules, but companies allow basically, it's usually other family members who have an insurable interest in the contract to be named as insureds. So if you had, say a 90-year-old who was uninsurable, and you wanted the contract to last for multiple generations, you could pick a very young family member to be the insured life. And many times there's multiple lives.
Perfect. And that keeps the contract in force in perpetuity as long as there is an insurable life on the contract. That's my understanding.
Yes, and the lives can be substituted over time. So there's, I would say, more flexibility than there is in the US context.
Perfect. And here's a fun question here that I wanted to ask. What is the compensation like? Because this has very different compensation than traditional life insurance policies do.
It's more like an asset management manager is paid. So typically, and these percentages go down as the cash values go up, but generally
Okay.
there's a 1% setup fee and a 1% annual M&E fee. And generally you split that with the company. But if they kind of structure that going down, say when it reaches 10, 20 million, it might ratchet down to 75 basis points, above 40, 50 basis points and so on.
Perfect. So there's break points in there. The higher the policy growth is, that amount above those limits has a lower fee. So combined, it will be compositely less than 1% when you factor all of the assets in.
Right. So, you're not getting, 100% first year annualized commission, but over time, the compensation can be quite good as cases build up for you.
So as we think about it, if we think about a $50 million policy, once everything's funded in there, 1% still split with the insurance company. That's a pretty healthy amount to receive. That's very much in line with the assets under management model, though technically it's not assets under management. It's I understand, right? It's assets under administration, just to keep the term separate from Series 65 types of activities there. So I want to get back to the questions here. I want to make sure I covered the things on my mind. Richard Jimenez asked, are funds in the policy accessed using loans?
Yes, it's very similar to, a US based policy. You can take out your basis, what the premium contributions, and then above that, there's a standard, usually it's but most companies, it's somewhere around 25 basis points, for the loan. And then again, if there's $1 left of cash value when you pass away, there's no payback on the loan.
Yeah, exactly. So everybody, I want to pay attention to that. That was a 0.25% interest rate on the loans. That's, this is institutionally priced types of policies that could be far better, depending on your client, could be far better than the retail IUL, VUL, whole life, and such, which has their own interest rate structures depending on how they're set up. Juan asks if is not based in the United States, what is the compliance within our law?
Well, it's pretty much the same. Companies, for the most part, follow the same regs, the 7702 regs that a U.S. carrier has to follow. I mean, there's the flexibility of different asset classes, but for the rest of the design, it's not dissimilar.
Perfect.
So there still has to
And
be the corridor rules. The one exception to that is the frozen cash value policies, which are not. I mean, interestingly enough, I mean, before the legislation in 1984, the TEFRA-DEFRA rules, you could have a policy with a very low death benefit and a very high cash value. But then they developed these corridor rules. And then, as we know, in the last few years, they've relaxed those. So you can actually put more in than you could, say 5 years ago, more cash value per death benefit.
perfect. Kevin McCartney asks, I may have missed this. Is the life company domiciled in, say, the Caymans? And we're not going to talk about specific companies, but I know that there's plenty around the world.
Yes, I think so. I'm not sure. I haven't come across one recently, but I think there's some. The ones I deal with are mainly in Barbados and Bermuda.
Okay. Brian Kibbaldis asks, are there any concerns with Fed's proposed changes to estate planning rules in 2025? Does PPLI have any hurdles here?
Well, these proposed legislation, the track record of going from proposed legislation to legislation is very poor, and so that kind of dovetails us into the Wyden's committee and the Green Book. So, I pay a little attention to that, but like I said, the track record has been so poor, and it's so politicized that it all depends on who's in power. But the main one of the things that interests me is the people who wrote Wyden's report, probably staffers, developed this cute phrase, buy, borrow, and die. But so they said it was so outrageous that these very wealthy people could buy a policy, take all the money out, tax-free, and then die with very little, cash value in there. But even what we might term as a lower middle class person in the US could have just a simple UL policy designed for retirement, and they can buy, borrow, and die too. I mean, it was a little shocking to me that the buy, borrow, die, of course, is there is kind of to rev people up against the ultra wealthy in a political sense, but that anybody that they didn't know they knew so little about cash value life insurance that, it's basic to every cash value life insurance policy, that's sold. Um, so that was a little sad, that obviously it was, the poor people who had to write these reports probably just, were under time pressure and had to produce something quickly, and maybe they knew nothing about life insurance. So, in that sense, my heart goes out to them. But it's kind of sad that, that the people kind of at the top of our government who are, proposing legislation really know so little about how life insurance works.
Yeah, and in a way, I kind of want to keep them that way. At the same, because I don't want to give them any ideas. You never know, which is another reason to support your NAFA organizations, FinSECA, all the associations that advocate on behalf of keeping and preserving our life insurance benefits, regardless of which format it is. Because once they attack one, eventually it will probably have to literally trickle down to everything else. And if we want to preserve those benefits, we got to make sure that we're advocating for the people that advocate for us and for our clients. Jimmy Ray, you've got some more here. So you say, would you mind breaking down the process a bit more? Using the case study with the family in California, the 100 million worth of real estate, and say they came to us today, how would we go about using a PPLI to help these people? And he goes on, how do we get set up to offer PP? Okay, that's the second one. So let's talk about the case study, 100 million of real estate. What would that look like?
Well, in the policy structure, you would probably form like a holding company or another structure, inside the structure, so to speak, that could own the real estate. And that would kind of, how you did that would kind of partially depend upon their estate planning goals. So it's a little too complicated to go into here.
Okay, perfect. And he goes on to ask, how do we get set up to offer PPLI solutions? Where would you suggest we look for training and guidance on this? Well, it's right there on the screen, my friend. That's part of it. Get the books. I haven't read yet. And I would say you contact Michael Malloy. There's his phone number. We haven't put his email in there, but or reach out to me and I'll help make sure that we all can get connected here and we can figure out if you've got someone worth working with on this. What I recently heard lately was that most PPLI solutions are usually offered through family offices. Very few insurance agents really know about this. And so it's usually the family office type of wealth managers that really are offering this and make it a talking point. Would you say that that's true?
Yes, I mean, it's very, each case is very case specific. Like right now, I'm dealing with a few young, crypto clients, and so there's, part of the challenge in each case is building the right team. So usually I have to go out and find, the right attorney and the right company who understands the assets. The companies have a certain comfort level with certain structures and certain asset makes. And like some are good with real estate, some are good with crypto. I mean, they all take, the stocks, bonds, those type of assets. But on the other, they have to have a certain familiarity. So part of it's knowing the landscape of what company will take what.
Mm-hmm. No, absolutely. And they've got to know how to value whatever that tangible asset is. How do you evaluate it and what, and I'm sure it's got to be evaluated for the beneficiary, let alone the insurance company and all the different parties that are involved. That's just me pontificating off the top of my head, I don't know enough on that, but I can only guess that there's multiple variations of how to value these things to make sure everybody's treated appropriately for the proper valuation.
Right, right. Yeah, they usually use third-party appraisers or third parties to value the assets. I mean, it doesn't always have to be a full-blown appraisal, but it has to be some independent valuation.
Okay. Richard Jimenez asks, if the client is uninsurable, is there such a thing as a private placement annuity? I already know the answer is yes. I have one small booklet that I've picked up on that topic. I haven't read it yet either. But even then, there's usually somebody that you can put onto the policy that has an insurable interest. So that would be my initial thought. What are your thoughts? Have you done private placement annuities?
Yes,
I
yes.
barely know how to say that.
Yeah, they work sometimes very well for short-term cases. Like if you had, say, a business executive moving to the US for, say, 5 years or something, and they want to be they're going to be employed here, but they don't really want to be part of the US tax system. So you can set up an annuity that's going to basically act as a tax shield. And so they're simpler to issue. There's, lower costs because there's no cost of insurance. But yes, in some situations they can work nicely, but they're subject to the same annuity rules. You have to take uh, you don't get tax-free withdrawals.
Right. Yeah, last in, first out, and other things, and probably the age 59 and a half rules and such
Yeah,
others,
they're
10%
subject to
penalties.
all that. Yes.
There we go. Okay. Let's, if we can't, Michael, could you stop sharing your screen? That I just want to open up my screen so I can see everybody too. And then Brian asks, it seems like having a holding company would encourage being able to utilize tax loss harvesting for various types of investment accounts under the same umbrella and get some deductions at federal and state level for taxes paid.
It's kind of a tax question, but I don't think you can do the tax loss harvesting in the traditional sense inside a life insurance policy. That's my understanding.
Okay. And that makes sense because there's no capital gains, therefore no capital loss deductions available in an insurance contract of any kind. It's all ordinary income. So yeah, I'm not sure about that. So Nathaniel Shapiro asks, does the death benefit reduce every year? And I suppose we're talking about the PPLI structure again.
Well,
I think maybe we're talking about the net amount at risk though.
Well, it depends on the policy design and on these two basic designs that I put forth earlier, the retirement design and the estate planning design. On one, and on both, there's a certain relationship between the cash value and the life insurance. So on the retirement one, there always has to be the corridor rules apply. And then on the estate planning design, as the assets grow, the death benefit grows, but it's a smaller part of the policy than on the retirement design, to keep it simple.
Juan says it seems like we're going to need a class on how to structure this product. Maybe not. My suggestion would be if you've got a prospect that's of higher net worth, that's looking for estate planning and retirement planning, I would say you call Mike, call Mr. Malloy, and we figure that out. So, and actually, you let the insurance companies figure that out. That's my understanding. Because if I understand right, when you've got a real good prospect for this, you'll set up a meeting with the company, and the company sends their representatives out, and they review all their contract, however, whatever they do, but they do that part. Am I correct on that?
Well, it depends on the company and the client and the size of the policy. But
Uh-huh.
yes, they're very much part of the team.
Perfect. And that, of course, keeps us all in compliance when the company starts doing things. That means that's on them, not me. Uh, and I always love being able to share any possible liability or deflect liabilities when we're giving advice, because then if it's on the company, we can document that very easily. And I like shifting that where possible. Um, Robert says, you mentioned that the transfer of insureds are available also. Seems like a second to die could be issued. Is that right? I think that's kind of built into the contract as to how it could be structured.
Yeah, yes, yeah, yes. The and that and just like a US based second to die, it lowers the death benefit somewhat. Um, you know, so yes.
Yeah, perfect. Nathaniel asks, death benefit paid to the beneficiary. And I think if I'm understanding it well, I think what we really want is to keep the policy in force almost indefinitely by keeping adding on new insureds that are managing the policy and the assets within it. Um, as opposed to actually wanting the actual death benefit to be paid out. It's more like something we want to really keep in force on an ongoing basis by bringing on new insureds, and others may be removed, whatever that process is. Is that our real ultimate goal? Or do we really want that death benefit paid out? And then, of course, we stop getting our ongoing annual assets under administration fees.
Well, yeah, it comes down to what's desired for the policy. So if it's like for this retirement planning that I talked about, uh, more than likely the use of the structure is for when the insured is living. But for kind of a estate planning and the family planning, what you outlined is kind of ideal because then they have a basic structure for their wealth, which they can keep going over multiple generations.
Yeah, that's amazing to me, because you just keep it going almost indefinitely, as long as there's someone that could still be added to the policy, meeting the underwriting requirements, et cetera. Um, at this point, yeah, we don't have any more questions, but these were great questions, guys. All right, Brian, got one more. Would an existing PPLI client be wise in starting a new company inside the plan, or get it started up first and then shifting into PPLI at a later date? Wondering how banks look at extending credit to such situations.
Hmm. I'm not quite sure I understand. Are we talking like about a 1035 exchange or?
I'm not going to pretend to understand, but as far as, let's say let's say they have their $50 million PPLI policy, they have it set up and it's funded with whatever it is, and they're looking to start up a new company. Should they start it up within the existing PPLI contract, or set it up separately and then 1035 it? I guess that would be the way to do it. 1035 it into the
Can you
PPLI
hear me?
policy.
David, can you hear me?
I got you. Hey, Brian.
Hey, good morning. Thanks for putting this on, man. I love your shows. It's awesome.
Thank you.
Gets me out of watching The View and Oprah, so thank you. Okay.
Oh
Yeah, so
God.
like you know how if someone has like a asset protection trust or a beat it, some attorneys will advise, you start your company when it's low valuation or no valuation inside the trust, so it's immediately out of your estate, especially if it's going to pop. So kind of along the same lines, brand new company starting it from scratch. Uh, has anyone done that? Have they started it inside the PPLI structure, or just kind of wait for it to get moving before making that? And I don't know if it would be an exchange per se or a note sale. I don't know how that manifests.
Yeah, these things are kind of company specific. What, like I said, an insurance company's capable of. But yes, I mean that's a very valid use of the PPLI structure. Actually, I'm working on a case now with crypto, which is somewhat similar.
Mm-hmm.
Someone who has
Well, very low basis
kind
in the crypto, I would think, and a lot of appreciation within it, as it's grown in
right.
value.
Well, these are founders, like founders tokens. So they're
Oh,
kind of worthless now, but there's going to be a liquidity event at some point, and they'll be uh, greatly increased in value if certain things come to pass. So yeah, because you're in basically this tax shield, it's ideal place for something that's going to blossom into the future.
very cool. Excellent.
Ask a question.
Richard said, okay, Kelly, what's up?
Well, no, I'll go in turn. I had a
Okay.
question, but
Let me
let's
get one more here. Richard asked, and I guess his suggestion might be you can borrow at the 25 basis points to start the new company, then shift the new company's assets into the PPLI. I mean, there's a way to raise capital as opposed to looking for other bank borrowing, especially if you have, a well-funded policy, you can borrow very preferred rates. I don't know. That sounds like a no-brainer to me.
Yeah, again, it's kind of company specific about what they'll allow, but it sounds like it could work. Yeah.
Okay. Excellent. All right, go ahead, Kelly.
yeah, one of the advantages that I think I perceived from other discussions is the perpetuity possibility of the policy. In other words, just staying and letting the family assets grow and grow and grow inside the contract. But it seems like you got to time it correctly to get a new beneficiary or new insured in there before the old insured dies. How is that handled? Because
Well,
if you wait
you
too
don't
long,
have-
number one's dead and you can't do it number two.
Right. Well, in those situations, generally you have several insured names named in there. So if somebody, passed away in a car crash or something similar, you would still be able to keep the policy going.
Okay.
All right, perfect. Well, any final questions, comments, thoughts? Because we are right at the top of the hour. This was really, really good. I think we got into some fairly good detail here as well. Obviously, the whole idea of this is not, can you guys do it yourself? Because, well, quite frankly, you don't even know who the companies are. The idea is, if you think you have somebody, let me or let Mr. Malloy know, and probably just through me, and I'll connect you together and everything, and let's see if it can make sense. And then from there, Mr. Malloy, he's got his fact finders, he's got his process, the things to figure out, can it be done, and if so, what will it look like? That's the most important thing. And so you don't have to be an expert on this stuff. This is something that I've learned from other people. The idea is, do you have enough talking points to talk a little intelligently, but at the same time say, I don't know all the answers, but I know who does. And then at that point, let's find out. And it's okay. Clients like it that you say, look, I got an idea that might benefit you. It's worth finding out. And then you bring in the expert, you let them figure it out. So you don't have to worry about trying to know it all, try to structure it all. That's not our job. Our job is to figure out, do we have someone that this could fit for, and go from there.
Yes, and
Real quick. Yeah.
I mean, our rule on our company is, I mean, everyone involved in a case should get paid. So I'm happy to split fees with you.
Perfect. Absolutely. And Jason asked a final one here. This is a good question. Do multiple insureds raise the cost of insurance per additional life being covered?
No. In fact, they lower it a little bit.
Yeah, because you're gonna blend the mortality rates in there, especially depending on ages that are being brought in. So anyway, basically you're looking for a higher net worth individual, Robert. Robert says top 5 use cases. Someone who has a high net worth, and as you said, 10 to 20 million plus. I would think anybody that has international business, international real estate, especially. Those are the things that are coming to my mind that where it's worth a conversation to then find out that could it make sense or not. Other thoughts, Mr. Malloy? Who makes a good prospect on this? Other than people who also really hate taxes, that's always good. But with these policies, they've got to hit the minimum available net worth that can be transferred in.
Yeah, I think you said it well. Yeah, on the international side, like Chinese families, they generally have 2 lives. They have a life in China and they have a life here, and the PPLI can help with both sets of assets. But like you said, anyone who qualifies in terms of net worth and wants a kind of simple, straightforward, compliant structure, with all the benefits that we talked about previously.
All right, perfect. That I think wraps it up. Hey, we did good on time. We're at 1 minute past the hour. Thank you all so much for being here, Mr. Malloy. Thank you for your time, and thank you so much. And I'm going to be uploading this here in a minute.
Good, yeah.